I'll ask my panelists one question, which they'll answer. Then I think we'll take some questions. I gather you've all been silent for quite some time. So I think I'll start to my due right. We'll start with some introductions, then we'll go into a question. So over to you, Geoffrey.
Good evening. So my name is Geoffrey Odundo, the CEO of the Nairobi Securities Exchange, and the headmaster of that chap there, who's kept you guys on your feet, I'm told. I think for me it's just to say I'm delighted to be here. I've enjoyed the whole afternoon session, and seeing this audience, which I consider quite senior, I'm overly impressed that the REIT products are actually becoming quite an impressive asset class. And especially this pitch we saw from the respective institutions, I think that has been probably for me the highlight. I don't know what else was said in the morning, but I think that has been quite refreshing. So thank you, and we really look forward to the discussions. Appreciate it.
Thank you, Geoffrey. Ngatia?
Good afternoon, everybody. My name is Ngatia Kirungie. I am the head of the KEPFIC Secretariat. KEPFIC stands for the Kenya Pension Fund Investment Consortium, which is a pension industry initiative that was formed to bring local pension schemes together to look at infrastructure and alternative assets, including REITs. We are supported by donor partners like the World Bank and USAID. We are partners of the REITs Association of Kenya. We also partner with the Fund Managers Association. And we have one goal, and that is really to see pension schemes diversify their portfolios away from just the traditional stocks and bonds into these alternative assets, including the REITs that we're here to talk about. It's been mentioned that capacity building, we've had the capacity building element is so key, and that's one of the primary goals of KEPFIC. And so we're very happy and very pleased to be here, to learn from the lessons that a lot of our contemporaries have gone through, and also just to connect and continue this journey that we're on as we try to push this agenda forward. Thank you.
Thank you. Einstein?
Good afternoon. My name is Einstein Kihanda. I'm the CEO of ICA Lion Asset Management. We are the REIT manager for the Island Fahari IREIT, and to whom all the fees should be paid for the REIT. As you've heard a lot, I mean, we have learned a lot of lessons from the REIT, and we are keen to continue to play a very active role in the REIT market. We are members of RAC, and we are keen to see the REIT market grow. Just a bit of history. Prior, I think my colleague Raphael gave a history of the Fahari IREIT. What I should also have mentioned is the fact that immediately the REIT regulations were enacted, we actually acquired a REIT license in 2014, and we were actually in the process of setting up a REIT, and then that Stanley transaction came up, and we felt that let us focus on building this REIT. So we've spent a lot of time over the last 3 years, and we believe we are getting ground, and so we are happy to be here and to participate, and glad to see the stakeholders are growing, and it means that there's a lot in store in terms of promise for the growth of the REIT market. Thank you.
Thank you, Einstein. And finally, Ewart.
Good evening, everybody. My name is Ewart Salins. So I work with Apollo Asset Management as the CEO there, but I wear potentially 3 hats here. So I am representing the Fund Management Association as the chairman of the Alternatives Committee, and I am also director at CASIB. But I think more importantly, at the FMA, one of the things we are trying to push is alternatives. And so my remit is to grow our awareness and sensitization within alternatives. So those of you who are familiar with the stock exchange, and at least since the promulgation of the Retirement Benefits Act in '98 and the rules thereafter in 2000, will be aware that really most of the asset classes that we've been investing in is just really strictly government treasuries, so govies, and a few liquid stocks, if at all. And really what we're trying to do at the FMA is try and sensitize fund managers to look at alternatives, and hence the purpose of this conference. And I think KEPFIC is having a conference thereafter. I think there is another one that was mentioned earlier. So we are trying to push the envelope on alternatives at the FMA.
Thank you very much, gentlemen. So the name of this panel is REIT Investment Panel, and I guess that's what we are looking at. So we'll start with a generic question, but I think that will open people's minds to what to look at when investing in REITs. So the question to all of you is, what are the opportunities and current challenges stroke barriers in the REIT space in Kenya? And I think we'll start with you, Geoffrey, then maybe the next question will start with you.
That's why I wanted to sit at the end of the queue. Thank you. I think I want to just reflect on why did we come up with this market and what is the opportunity that we saw. So historically, property ownership in Kenya has been direct ownership, and we could see that there was limited scope of entry. I mean, the barriers to entry were quite huge if you want to go to scale, as people have said here. So you'd find only institutional investors, large organizations are the ones who could own property. And so the barriers to entry was one concern we had. The property market wasn't growing as fast as could because there was lack of, there were challenges on entry. Secondly, liquidity was a big concern. It was another barrier. Pension schemes, SACCOs, private companies, insurance companies were sitting on these assets that they were so illiquid and could not exit. And then the third one that we saw was the return, which again had been static for a while. So we asked ourselves, what are the opportunities and how can we then help provide a solution? And in 2015, after research and a lot of market discussions, we came up with the REITs market. And we came up with the regulations and got the first issuer and launched the market. And I know it was a painful journey. But I think what we also looking at other jurisdictions, especially the US, we realized that almost 98% of the pensionable direct property assets are in REITs. Just 2% is in direct ownership. So ideally, that presented that there's a great opportunity to venture into this area. I think what we were not careful about was to look at the whole cost structure of this particular REIT. So again, the cost of setting it up was pretty expensive. Eventually, there's been a lot of development and a lot of progress towards addressing that. But if you look at the opportunities that exist in this market, I mean, when I was looking at the Econ development, and I must applaud Edward and his team, there's been a very big housing deficit for different categories of people. Like, let's start with the students. If you look at the government's projections on the population of university students, it's quite high, and we don't have enough accommodation. And it's a target under the PPP for the government to develop hostels. Now, that's been a target for so long and has never been actualized. So I think Econ coming to this space, and one time I sat with Edward and he told me that we have a huge youth bulge in this country that we need to address, and that's how this space has come out. So that minimum supply side in that category of that segment of the market is one great opportunity, and you can see that happening. The government is now on a 250,000 annual target housing scheme. Again, to fulfill that, they can't do it alone. So there's a private sector required, and that's another opportunity, and I think that's what you're going to see. We have a urban-rural migration. I think with the development of counties, again, a lot of infrastructure is required, and housing is critical. I was just so impressed to see what Mivida is doing. This is actually in Ruiru, outside Nairobi, way outside, but look at the kind of facilities that we have in that space. So look at that. So the urban area is expanding into those horizons. And just yesterday, I was talking to Einstein and just telling him, I'm so impressed today that today, if I'm in Kamiti, Zimmerman area, if I'm going to Mwiti, how many of you know where Mwiti, is it Mwiti or Mwiti? Mwiki. Who's been to Mwiki? Do you know you have Java there? You have chicken in there? Did you know that? KFC in Isili. So Kenyans are becoming discerning, asking for trendy, coming up with moving the trends, and housing then has to follow. And I was so impressed to see that you have a serious facility in Ruiru. So all these are opportunities that are coming through, and actually I see a limitless scope. The final thing I want to say is how then do we help already invested organizations unlock this value? And that's why we are saying we are really trying to build this REIT knowledge. I'm so delighted that today pension funds have found a solution for their overexposure in property. Okay? So you find we have the first REIT from the CPF, and they were here in the morning. Now that should provide like a template for all pension schemes to address that overexposure in their property portfolio. The next set of people I want to see here are insurance companies who are currently required to have certain capital adequacy ratios for property exposure. So the solution exists. Let's just take advantage of it. Thank you.
Thank you, Geoffrey. Ngatia?
On the opportunity side, I think it goes back to where I first started, which is diversification. It's really, really important. I think the fund managers in this room are having very difficult discussions with their clients this quarter, where they are reporting the performance on government bonds has gone down, and we're also seeing equities also suffering. If your portfolio is simply in those two asset classes, then you can see how your clients would be very upset. The other thing is, our fund managers are also limited to only investing in the same opportunities. So not only are the markets underperforming, but you're all underperforming together, right? Which maybe there's some comfort in numbers, but there's also very little way to differentiate yourself. And now introducing a new asset class like REITs gives us the opportunity to diversify, to differentiate ourselves, and to, in general, lead to higher risk-adjusted returns for our clients. The other thing that is important about REITs is that they allow the pension schemes to have exposure to property without direct ownership. I've been to a few presentations where Raghav of Aecon has mentioned that if you are a pension scheme and you believe in the telecom sector, you don't go out and start your own Safaricom, right? You find a listed instrument that can give you that kind of exposure, and you have to understand that going into some of these areas of opportunity require that specialist expertise. And so through the REIT model, you can actually now get this specialist expertise in hospitality, in student housing, in affordable housing, and the likes. Liquidity. Now, liquidity is both an opportunity and it's a current challenge. Liquidity allows these pension schemes not to have to own an entire building and to have to sell the entire building to realize their returns. And so obviously that's a big tick. But it's a challenge in that currently we just don't have that liquidity. When we look at the trading volume of the Ilam Fahari REIT, I looked right before we came on stage. Last 3 months, it has been about 6 million shillings. So on one hand, we are saying this product will give you the opportunity to buy and sell, trade in and out, and increase or decrease your exposure as you wish. But on the other hand, the facts on the ground are not showing it. In terms of one more challenge, and I think this is, I guess, the reason why the REIT toolkit even exists, it's the limited market depth. Yeah. For as long as we have 5, 6, 7 REITs in the market, they will always be considered as an exotic product. And conservative investors like pension schemes do not want to invest in exotic products. Yeah. But the more REITs we have in the market, the more sensitized they become on how these instruments function, on the underlying asset class. And then now it becomes a lot more palatable, a lot more interesting, a lot more easier for them to say, not only are we going to go into REITs, now REITs are not, whether we're investing in REITs or not is not the issue. It's what REIT, what underlying asset class. It's just the same way today, they are buying equities. They're not sitting here today wondering, what's a stock? Yeah, should we be buying stocks? So the more product we put in front of these pension schemes, the more comfortable they become. And so that's why we're very encouraged to see what the REIT incubator is doing. The 3 pages of toolkit tools, very, very powerful. And we hope to see in the next iterations of these kinds of discussions more than the 6 or so companies that came up to discuss their product.
Thank you, Ngatia. Einstein?
Yeah, I think for me, in addition to all that has been said here, I think the important aspect I want to bring out is the issue of investor awareness. I think it's been talked a lot about here, and I recall when I was on the other side, when Studlib was, the REIT was getting listed, and there were a lot of questions. People wanted to know what is a REIT, what is this all about. I can say we've made major steps since then. Looking at the kind of the forum that we have here today, but I think there was something that was said earlier on regarding the pension funds, because at the end of the day, if you look at I think it was Luigi who was talking about the composition of the boards of trustees. See, at the end of the day, those are the stakeholders that you need to sell to. And in view of the level of sophistication in terms of investor knowledge, we need to be able to simplify this whole aspect of REITs, because I think that will contribute significantly to the acceptance and education and understanding about REITs. So I think we have a lot of work to do, and I think even in the morning a lot of this was said, but I think I can't overemphasize it, because I think that a significant aspect of the performance, especially at the IPO level, even of the Studlib REIT, one of the factors, of course, was about investor awareness. And I think we've made major steps, but I think there is also a lot that still needs to be done. So I think we have a significant challenge and obligation as stakeholders in the sector to be able to add and contribute to the enhancement of information and knowledge about REITs. And I think there's hope. Looking at where we are now, and the fact that even at government level now it's part of the conversation at policy, I think we will be able to make significant progress.
Thank you, Einstein. Ewart?
When you sit right at the end, everything that needs to be said has been said. But let me just echo a couple of points. The asset diversification, I think Justice mentioned earlier that I think the next 3 to 4 years, you're looking at from 1.6 trillion to 2.4 trillion. I suspect probably double, maybe 3.2 trillion. So if you think through that logically, what's the market cap of the NSC, and where would a fund manager invest? So yes, you've got your govies, you've got your equities. Hopefully we will get some listings, but you need alternatives, guys. And the very fact that, hopefully we get 500 billion coming on stream with REITs, that would provide a really lovely asset class for fund managers, to invest in. The opportunity, you all know the inverse relationship between your rates going up and yields going down. The fact that that happens, and now it's really coming to bite those with AFS portfolios, means that if you have real estate assets, it really helps you, cushion against the yields going down. In terms of challenges, I think the fact that there are no market makers since the listing of but all the REITs that I've listed thus far, the trading, the liquidity is not that much. We almost need, dare I say, a market maker to ensure, just like the ETF that we have, just to ensure that there is liquidity in that. The lack of awareness, which Einstein had just mentioned, and can I just call out Jane Kinua? You're a trustee at CBK, right? Now, you said you've heard of REITs for the second time today, and your son was the first person to tell you about it. And the fact that you're a trustee at one of the largest pension funds in the Republic of Kenya, either way, it kind of like shocks me, purely because then it means that we're not doing a good job, right? We're just doing actually a pretty rubbish job. And that means we really need to start educating trustees about the opportunity in REITs. And I was almost going to say, the other day, the CMA sent me their accounts, and I looked at the surplus. It was 200 and something million. And I called Willie about this, and I saw 147 million was returned to Treasury. And I was like, dude, can we not use that money to just educate trustees? Because it's not a one-off seminar in Naivasha once a year, or I hear the Istanbul these days, and somebody went to Bangkok. Well, you took your trustees to Bangkok, right? Yeah. So it's got to be continuous, like continuous education, because only then will the penny drop with trustees that REITs are a viable investment. And then finally, I think that there's a point that's been brought up here, and I wish the regulator, I saw Justice leave. The fact that two market practitioners, earlier today, Raghav mentioned collapsed D-REITs and I-REITs together, into one. And then David Luigi mentions the same thing. Guys, these are market practitioners. They're not theorizing here. This is real life. And I would like the regulator to take that suggestion on board and say, guys, we got to do something. Because if we don't do something quickly, I don't know if you guys follow LinkedIn, KIFC, Kigali International Financial Center, and all of that. We as Nairobi, I'm a big believer in the stock exchange, NIFC as well. We really need to start pushing and start moving quickly, guys. Somebody mentioned South Africa earlier. I was just reading a little bit about South Africa. When did REIT start in SA? 2013, right? They have, who mentioned 33 REITs? 33. We have what, 4? Like, guys, we got to benchmark ourselves, not against Rwanda or Uganda or Tanzania. We've got to benchmark ourselves against the best. So benchmark ourselves against South Africa, benchmark ourselves against Malaysia or the UK, and we've got to really move with speed. Otherwise, this conversation will go stale.
Thank you, Ewart. I think before I take the next question, we'll agree that we've got a depth of knowledge up on this panel. So I'd just like to ask, does anybody have a question? Not necessarily investor focused, but a burning question that they feel, Geoffrey can address from an NSC perspective, Ngatia from Kempinski, Einstein from a fund manager's perspective, and you as somebody who's looking at alternative investments. Sometimes you sit on a panel and you're likely to create all these questions, and then maybe during the whole conversation during the day, there's some burning issues. So do we have any questions at this stage?
I was earlier introduced, so I'll not introduce myself again. My question, I would have wanted to direct it to Geoffrey, but because I am trying to get help from him, I don't want to put him on the spot, so I'll keep it open. But this is the question. Another point that I keep hearing is we are doing the listings, but very paltry performance at the secondary market. Your thoughts, gentlemen. What can we do to spur either market making or better activity at the secondary market for these alternative asset listings? Thank you.
I think as they put the answers together, and if we can also have somebody give Zoraba the mic.
On behalf of this program, so now I think, we've gotten to a stage where we've gotten the fund managers, the transaction advisors, the lawyers, we're all sort of rowing in the same direction. Now the next step, I think, are the trustees. How do we engage them? What does that look like? What might be the duration of that process? Who are the key stakeholders we need in the room? I think the case for REITs we can build and make. I think we've got a lot of now research on that, but how do we do it?
Okay. So I guess we'll start with Geoffrey on the performance of current listings, and then your thoughts on engaging the trustees.
One of the things that we look at on a daily basis is the data that's coming out of the trading performance we see, and just trying to understand that data. I think for alternatives, the challenge we have is, like a new product, the learning curve. If you look at the psychology of this market, before the market responds to new ideas, it takes quite some time. People are still on the learning mode. The understanding takes some time, and hence it doesn't really pick up. I'll give an example. So we brought into this market the ETF product, for instance. I'm speaking about alternatives now, the exchange traded funds. And for a long time, it was very dull. We tried to bang table seminars. I think we held over 6, 7, 8 seminars, but there was still no traction. Until we got one market player responding to it. And all of a sudden, the market took off. And now we don't have any units we can trade. Similarly, the REIT market, it's been there. We started off with the ILM REIT. Again, the challenge of ILM and the misperformance. But again, it's a product that took some time. And again, the lessons around that was a bit challenging. Derivatives, the same thing. So I think what we have in this country is the adoption curve sometimes is quite slow. We don't respond immediately. And again, there's been some level of comfort in dealing with only 2 asset classes. I was a fund manager, and I remember I used to invest in equities and bonds, and I still see the fund managers doing the same thing, not to put them on the spot. But you have to be bold as fund managers to deliberately push your trustees out of that comfort zone and tell them we have to move forward. And I'm happy that, okay, I'm not happy. I must say what's going on right now where both markets are misperforming serves as a lesson for them to get out of those comfort zones, isn't it? Because the people who have hedged into alternatives are performing a lot better. And I think that's the message that's coming out of this. So to spark this market up, we have to be very deliberate and have a market push. I'll give you an example of what we used to do when I was a fund manager. We used to have a and I think FMA was born out of that. But now we were a few fund managers then, about 6 of us, and we would sit down over lunch and ask ourselves, what do we need to do to spark this market? There's an IPO coming. What do we need to do to boost it? And we'd commit ourselves to go out there and convince our trustees to step in and invest, and they would respond. I must say then trustees are not as bright as they are today, when Einstein can take them for international trainings. Probably that's another challenge. Probably that's another challenge. But I think we shouldn't give up. Luigi, we should actually be out there deliberately showing the alternatives. And I've been telling trustees, for instance, you tell us to put money in fixed income. Now you're losing money because of AFS, right? Hedge, we told them to hedge using derivatives. A lot of them still have not seen the light of that. But I think as risk is now about managing risk, not return. How do we manage risk? Diversification, hedging, alternatives. And that should be the turnaround for this market. Yeah.
Thank you, Geoffrey. So Ngatia, the same question, the performance of current listings and maybe perhaps with the interaction with pension schemes, more what you feel the trustees need to see or hear or be taken to where to.
Sure, and I think it has been touched upon. I think demystifying REITs is really important, but I want to expand it not just for trustees, right? If you remember back in the day when our equity market was really booming, it was being driven a lot by retail investors, yeah? And so right now we're talking about trustees, we're talking about institutional investors, as if we have completely forgotten about the role that retail investors play in the health of our market. And so demystifying this product to retail investors is equally, if not as important, yeah, or if not more important. Safaricom trades every day whether or not the largest pension schemes trade it. Yeah, and that's because the retail investors are interested in getting exposure to Safaricom. Why should that not be the case with Mivida? Why should that not be the case with Aecon? So for me, when I think about the capacity building side, and in fact, I don't even know, I think that word capacity building, or that phrase capacity building is also overly complex. When I'm just talking about sensitizing the market or investor preparation, we should be careful not to forget the importance of retail investors.
Thank you, Ngatia. Einstein?
I just want to extend that, what Ngatia is saying with regard to the history, just a bit of history. If you look at also that boom, there was also to some extent, the role of government. If you look at the last 20 years, when we've had booms in the market, I think there was a Kengen IPO, we had Safaricom. And I think that also helped in terms of the national conversation, in terms of just enlightening people about investment opportunities. So I think it's also possibly a plus that the REIT aspect is also coming in terms of looking at what opportunities are there for investment, especially from a government perspective. So I think that is also from a policy angle to it that could also significantly contribute and add to the confidence that the market would have and the ordinary mwananchi would have to understand about REITs.
Specifically to answer Luigi's question, I'm not quite sure I have an answer, but maybe I can draw a parallel with the Absa Gold ETF. I mean, they are the market makers, so maybe we need to find some way of being a market maker within, the REITs. I mean, so that you have someone who's going to be the buyer and seller of all shares, within the REIT. So I think that we need to look at that in a lot more detail and maybe draw some lessons from other markets like the JSC. Very specifically to what Ngatia has just said, capacity building. I think there is capacity building that can be done. I mean, on the one hand, yes, there is educating trustees, but on the other hand, remember the capacity building doesn't just happen at that level. It also happens within investment banks, within fund managers. Just because you are a CFA charter holder, whatever, doesn't mean you know how to analyze a REIT or a property transaction. So there's a lot of capacity building that needs to happen at that level, at the analyst level. And I just think we do need to, let me give you a real live example. I mean, if you give me an extra minute, if you go back about 25 years within the market, when we analyzed the Nairobi Stock Exchange, the best stocks, and maybe Einstein can attest to this, were the cheapest. So if you were like 2 shillings or 3 shillings, you were a good stock to buy. It didn't matter what the multiples were, you're a good stock. I kid you not. And then relative analysis came in, and then thereafter fundamental analysis came in. And that's where the capacity building, by the time I think 2002, 2003 came up, 10 years later, that's when you saw some analysts within this country that really started gearing up. The CFA charter, ISIFA came up and all of that, and CC as well. So just building capacity at the analyst level is very important. MiFID II sort of killed it a little bit, but building that capacity on the real estate side, I think is going to be very important so that we can, what is cap compression? What does that mean? I mean, try and educate people what that means, and try and educate analysts.
Sorry if I may. On the retail side, I think Ngatia had a good point. If you look at the future is the youth, right? Someone tells me they comprise almost 70% of the current population, and I don't think they are sentimental to these properties that we buy directly. We must create products to address that future investor. Now, I think one of the best ways to do that is to have aggregators. Be they through the unit trusts, CISs, and also I think Aircon is looking at a VUCA platform where they can still own property in REITs, right? They can still own the REITs, but through an aggregated form. So I think that's where we're going to get it. Retail actually is one of the key solutions towards sparking this market. But it has to be done in a way that it doesn't, it's not exposed. They've got professional investors, and that's why an aggregated direction would be the suitable one.
Thank you for that. I gather we've got a comment on trustees from the floor. Then if Raghav can just come in, there's just a small thing I note he's not on the panel, but it's something I want to ask him. And then maybe one more question and we can wrap up the panel. So I can ask my panelists to think about their last words and last thoughts.
Thank you, Chairman, and sorry for having to comment at this stage, but my thinking is that for most trustees, especially those who are said to have overinvested in property, the minute you mention REITs, they think we look like we are still going to buy more property. So it's looking at it that there is need to see how to exactly state that so that they may see the REIT as the answer to their problem. In which case, I would suggest that there be targeted, very targeted sort of presentations when you just want to address that issue and address it in such a way that they get it. That even if you are saying get to REITs, you are not going to get to overexposure. It is actually addressing the problem of overinvestment in property. Because for most, the minute somebody closes up, because the REITs for them is properties, and they already are hearing that they're over, they're over in terms of the investment. So there's a way somebody ends up closing their minds. So I think there's need for that, and it could even be addressed through this newsletter, because like now we have trustees who are seated here, and somebody to just be deliberate on how it addresses it. Thank you.
Thank you.
Could I just give one comment on that, maybe a rejoinder? The Lab Trust REIT that we listed actually were looking for that solution, and that's how they did it. They wanted to reduce the exposure to property, and so they converted the entire property portfolio into REITs, and now they're in full compliance. I like the point about putting it in the newsletter, so it becomes like the template for that.
I think for PPR, that should be what the next letter should be about, a proper in-depth sort of look at education, at branding, and all of that. I think we'll take a question from Willie Njoroge. While Willie is giving us his question, I just wanted to ask Raghav. We've had this, and I apologize for putting us, but we've had this conversation about collapsing an I-REIT into a D-REIT, basically having a REIT that does income and development all in one. I know for the TOOLKIT incubation team, if it was one, you already have fewer documents to fill in, you know, so there's that simplicity part of it. So for Raghav, just as Willie gives his question, I want just to, when you look at it from your own perspective, you know, would it really simplify what you're going through in terms of even your cost, management cost expense ratios and all of that? Because I think sometimes when you're, like Ewart was saying, when you're putting these things to the regulators, you tell them, this combined REIT is giving us better yields, and we're removing another layer of sort of Chinese walls and costs and all of that. So maybe you can just 2-3 minutes on that. But Willie?
Thank you very much, Chairman. I had a bit of something to share. It was first a question, but I think from what the panelists have said, it has developed into a thought. And I wanted to ask, especially Ewart and the entire panel, when we talk about having a REIT product, is it possible to have a one-size-fits-all REIT product that is attractive to the high-risk, youthful population that you'll see every day in the forex market, while at the same time be attractive enough to Einstein, who's totally risk-averse? Yeah. Is it possible to have a product that meets both populations before we even go to the market to start marketing? But then Jeff has said something about aggregating, and the thoughts that I'm thinking, and maybe the panel can also comment, is one of my members talked earlier, and that was Cynthia. She talked about having rates that appeal with a household name. If you have a KICC rate, everybody knows KICC. If you have Harambe, everybody knows Harambe House, okay? And if you think about it, when we did the Kengen IPO, we all knew Kengen. When we did Safaricom IPO, we all knew Safaricom. And I think that works towards the marketing and the selling of the product. So as we come to aggregate to what Jeff was saying, would it be possible for us to aggregate these rates into what I can call quote-unquote household names? Because if I go out there and I say that I'm releasing a CASIB rate, who is CASIB? Who on earth is CASIB? Who knows CASIB? But if we get household names, it might be an easier sell for us when we're getting this out to the market.
Thank you. So responses?
I guess in a word, perhaps not, because you're talking about having a really high-risk REIT and a low-risk. I mean, remember, the fund managers are beholden ultimately to trustees and pensioners who give us a hard time every 3 months. I mean, there you lose some money. I'm sure, Einstein, you're going through a hard problem right now with your trustee meetings, right? So high risk, I would say caveat emptor, you know. And see, the problem with retail as well is the moment one person gets burnt, it just spreads like wildfire, you know, that this is a bad product when perhaps it's not. So maybe you would have to have, I like Jeff's idea of aggregators, because if an aggregator buys a REIT, then it means the fund manager is doing his due diligence, his ultimate due diligence, to ensure that the product he's giving his client is, you know, is investment ready and makes investment sense. So anyway, I'll let Einstein.
No, I just wanted to add that one of the things that you also always have to remember is it's really about the underlying asset. Because at the end of the day, the REIT is a vehicle through which you're presenting this opportunity to investors. So I think it will have to be on a case-by-case basis, basically in terms of what it is that you're looking to develop in terms of the underlying property. It's probably not possible to have a one-size-fits-all, but I think as we now have more and more coming onto the market and the market gets more aware about these opportunities, we'll probably get to a point where it's going to be easier to sell to the market. But I like your idea in terms of having a catchy and something that resounds with the retail market in terms of selling. Yeah.
And the underlying asset doesn't have to be an historical old brand. I'm sure today, if you are told to be an owner of Kwetu, you all want to be part of Kwetu, right? Because of what you see, right? So it's the underlying asset that he's talking about, and really sticking to your objectives in terms of returns and transparency, just to be sure that the investors get comfortable with you. Yeah.
Thank you. So Raghav, over to you. You know, guys are talking about collapsing everything into one REIT, no separation. From somebody who's practicing.
And
your
I
thoughts?
Think actually, in a way, the question also ties in with Willie's point as well about one size fits all. So first of all, Ewart, you attributed a statement that I didn't make, so be prepared to hear from my lawyer. I actually don't think that combining the two REITs is a good idea. I believe that it's good to keep them separate. The reason being that they have different risk profiles, they have different return profiles. The basis for operating them is very different. And my concern would be that if you were to commingle them, and let's say some issuers were to do both at the same time, then the whole transaction monitoring, the accounting, how it's being reported on, would get very jumbled up. And I mean, a lot of that headache would go to the REIT manager, which as a REIT manager, I don't want to take on that kind of headache. So from the sounds of it, and I apologize if I missed the morning session, but from the sounds of it, the driver for combining the two seems to be something to do with documentation. If that's the only reason, I think that it's not something I subscribe to. I'd rather go through the extra effort of having two separate REITs. Although we are offering them as a blended offering, an institutional investor is coming into both. The fact is that we also have retail investors who come into the IREIT. And I do not believe the regulator, or frankly us, would be comfortable having retail investors being able to come into a development fund, because that's a very punchy, very risky profile. And that's something you need institutional, sophisticated investors to come into. And I think it was Einstein's point, or one of the panelists right now, retail investors are just waiting for something. And at that point, even if they don't understand it, it's something that the next thing you know is blowing up on Twitter, and there's all sorts of news articles. I don't want that. I think it's better just keep them separate. That way, there's going to be some issuers here who are looking at just developing, and they want to have an offtake mechanism. So let them have that. Just let them focus on a D-REIT, and that's all they offer. And if there are others who are looking, like iJenga, at delivering income-yielding assets, and that's all they care about, let them have an income REIT. I think it's a good thing that the regulator has provided regulations for these two separate type of vehicles. Long may they continue.
Thank you for your thoughts. So I think, gentlemen, we'll have to leave it there. So just to my panelists, 30 seconds, parting shot, starting with Ewart, coming up this way.
Well, I think, I forget her name, the chairman of the Kenya Green Building Society. Asmina, yeah, I think you said 80% of the buildings are yet to be built. I mean, that's a sobering thought, right? And if 80% of the buildings are yet to be built, there's so much that can and should be done, just from green financing to using REITs. We were all at a panel about 3 weeks ago when we were told that there would be 53 trillion, not billion, $1 trillion of green finance available within the globe by 2030. Right now, apparently, there's $4 trillion that is looking for and seeking green assets. Is that money actually touching us locally? Not yet, I don't think so, but perhaps as developers, if we're looking to do green financing, it's money that we ought to be looking at. So let's keep this conversation current and keep it warm, but we must need to act with speed.
Thank you, Ed. Einstein?
I think for me, today's forum is a reflection of the growth and the maturity of the real estate, the REIT market, that the stakeholders have increased, and we're having more and more serious conversations about how to ensure that we roll out this to the wider market. From where I sit as a fund manager, the engagements with the trustees are critical, and I think the challenge is on us as fund managers to really do what we need to do in terms of that active engagement. Of course, the circumstances of the market have helped, have kicked us to ensure that we actually are actively looking at the alternative investment space, and REIT is a critical asset class in this respect. And we have the regulations and I think pipeline of products coming to the market. So I see the prospects for REITs as very promising.
Yeah, thank you. Ngatia, then Geoffrey.
So, number one, let's continue to demystify REITs, right? And how they work, how the cash flows work. Let's pull back the curtain and show everyone that it is not a complex instrument at all. Yeah, we need to stop talking about REITs like it's like we are some form of sophisticated subset of investors here. Yeah, that's the only way that they will be adopted by the rest of the market. And I like the example that was given about your son talking to you about REITs this morning. The only way that was possible is because he understood it. And think about him as a potential retail investor who was now educating his mother, who just so happens to be a trustee. Yeah. Remember, the trustees are individuals like you and I. So they must also understand themselves. It must be appealing to they themselves as individuals, even on, you might want to call it retail or otherwise, but it has to be separated from their institutional role. Because it is only once that happens that they can sit in their seats as fiduciaries and then now say, yes, we are comfortable with this new asset class because we understand it. We don't need to have our fund managers come to tell us about it because we have a good sense about it. And then at that point, you hope to be able to supplement that or complement that with product. And this is a numbers game. Like I said, if you have just three REITs, all of them are super risky. Yeah, but if you have 30, then you might find 10. You might have some form of stratification or preference that will build up naturally, where the market will naturally say, these are high-risk REITs. Maybe we'll put less of our portfolio into them, but these are now less risky REITs, so let's go into them. At that point, you're not talking about risk REITs or not. You're talking about which ones, and I think that's the direction we should be going.
Thank you.
I just want to ask a question. How many are over 40 here? Don't be shy. Chatham House rules will not say out of this room. How many are we over 40? How many are below 40? Yeah, they're almost the majority, right? So the future is sitting here. I remember when I graduated, I was told to get your first job, and the first asset you buy is a house. And that was the age of 30, and I bought a property. And I still have it, but that was it. And I'm still paying the mortgage. These youth are not interested in our investment psychology of property. If you ask your child today, they don't want him to live here. They want to live in Europe. They're global citizens, isn't it? So we have to get products that address that need because it's coming. They will sell all these things. They will sell all this property to Einstein. They're not interested in it. They're not. I'm telling you the truth. So the 500 billion that Zarava is talking about is a reality. So let's not wait for that to happen to us. I mean, we just run ahead of them. I think we can change the investment culture in this country and allow people to own assets in a more innovative way. I think that's what I shared with Edward one time, told me that the future will be REITs because the youth are coming for it. So that's what I'd like to pass. The NSC, We are so delighted that we have 4 REITs now, and we hear the pipeline is growing. And so we just want to encourage the rest of you, especially trustees, to take advantage of those opportunities. Thank you.
Thank you, gentlemen. So on my behalf and on behalf of RAC is just to extend our sincere thanks for agreeing to sit on the panel and share your knowledge. I think we're going to have a few more of these workshops. So I think we'll leave it there for now because we've got a wrapping up session and then obviously get to the drinks.